If you feel like the Arizona housing market is better, but still uncertain, you're exactly right. Contracts and escrow across the valley are up 7% compared to this time last year. That's real movement. But here's what most headlines won't tell you: it's better, but it's not easy. And whether you're a homeowner in Mesa thinking about selling or a buyer trying to time the market, the difference between winning and missing right now comes down to understanding what's actually happening underneath the surface. Let's start with buyers because their behavior is driving everything. Right now, we're entering the busiest stretch of the year. Historically, February through May are peak contract months in Arizona, and demand is improving. It's still technically 60% below normal for this time of year, but last August, it was 24% below normal. That's a significant recovery. But why? Because mortgage rates stabilized. For nearly 6 months now, conventional rates have hovered in the low 6% range. FHA and ARMs are sitting in the mid 5% range. And here's the math most people aren't talking about. Non-luxury home prices under 800,000 are down about 4% from last year. Combine that with rate improvements, and the average mortgage payment on a median-priced home is down roughly 14% compared to this time last year. 14%. That means if your payment would have been $2,500 last year, it's about $350 less per month today for the same home. That's not theoretical, that's happening right now. And here's something even fewer people understand. Every 0.1% drop in mortgage rate equals about 1% off your principal and interest payment. Every 1% drop in price equals another 1%. Each 1% equals roughly $10 per $1,000 in payment. So when buyers say, I'll just wait 3 to 6 more months, what they're actually hoping for is another big payment drop. But realistically, even if rates dip slightly and you're maybe saving another $30 a month. Meanwhile, contracts are rising. We're heading into peak season. Competition increases. That leverage you have right now, it shrinks. Now let's zoom out to supply. Inventory in the Arizona Regional MLS is up 9% over last year. And for the first time in 14 years, supply across Greater Phoenix is considered normal for this time of year. That's huge. For over a decade, we've operated in chronic undersupply. Now we're balanced, but balance doesn't mean the same thing everywhere. The valley overall is in a slight buyer's market. Large central cities, modest seller's markets. Outskirt growth cities, Buckeye, Santan Valley, Surprise, Goodyear, are in prolonged buyer's markets because supply is higher. Builders in those areas ramped up production, then demand slowed. Now they're offering incentives, and annual sales have increased as buyers take advantage. But here's the hidden stabilizer. Developers are scaling back permits to avoid prolonging oversupply. They're actively preventing a crash cycle. That's not something you see in the headlines, but it matters long term. Now let's talk about Mesa specifically. Mesa is one of the most layered markets in the valley. You have entry-level homes, mid-range move-up homes, retirement communities, and luxury properties all operating slightly differently. And here's what's critical for homeowners on the fence. It's business as usual. That's the honest answer. The professional advice from last year, it still applies. But the environment is healthier than it was last summer. January is historically the top month for luxury and retirement listings. March is the top month for mainstream sellers. So every year we see a wave of new listings hit the market ahead of peak contract season. And what happens next? Existing sellers start lowering prices to compete. It's a cycle, but here's the difference this year. Early price reductions are down 4% compared to last year. Sellers are learning because buyers have changed. When we shifted from a seller's market to a buyer's market, something psychological happened. Buyers stopped negotiating from inflated prices. They ghost. If a home is priced 5 to 7% above what buyers believe it's worth, they don't write an offer. They move on. But once that home comes within 2 to 3% of where buyers believe it should be, offer probability jumps dramatically. That 2 to 3% window is everything. And here's what homeowners need to hear. Aligning with comparable sales is no longer enough. Today's buyer wants the biggest bang for the buck, not compensation for every upgrade you've ever done. Condition is critical. A clean, well maintained home with newer systems and minimal future projects will outperform a slightly cheaper home that needs work. And this is counterintuitive. Simply discounting for condition often doesn't work. In a buyer's market, buyers don't want the hassle, even if it's cheaper. Sometimes providing contractor quotes or even handling work before close of escrow is more powerful than shaving off price. Now let's chat about luxury. Luxury behaves differently. Homes above 800,000 are less rate sensitive, but they are expectation sensitive. Luxury buyers are analytical right now. They're watching days on market, price reduction patterns, seller concessions. They are not emotional. If you're a luxury homeowner in Mesa and you overprice to leave room to negotiate, you risk invisibility. The luxury market still moves, but only when positioned precisely. And here's what many high-end sellers miss. Buyers are benchmarking your property against new construction, even if it's not truly comparable. If there's a new build within 1 to 2 miles offering incentives, rate buydowns, or turnkey finishes, that affects perception, even in luxury. Now, if you're a homeowner on the fence asking, should I sell now or wait? Here's the strategic lens. Demand is improving, payments are lower than last year. Inventory is normal, not flooded, and we are not in a distressed market. But we are in a competitive market, which means timing alone won't determine your outcome. Strategy will. That means pricing within the 2 to 3% psychological window, positioning against nearby competition and builders, preparing the home properly, and understanding negotiation trends. That determines how much you walk away with. And if you're buying, this is one of the most financially improved environments we've seen in the past 18 months. Your payment is likely 14% better than it would have been last year. You have more inventory and you have negotiation leverage, especially in areas with higher supply. Waiting may not meaningfully improve your payment, but it could reduce your leverage if competition increases through peak season. So here's the bottom line. The Arizona market is better. Contracts are up 7%, inventory is up 9%, payments are down roughly 14%. But better doesn't mean automatic. It rewards precision. If you're a homeowner and you're even slightly curious what you could realistically walk away with in today's market, not Zillow, not guesswork, but real numbers based on current absorption rates, buyer demand, and negotiation trends, reach out. We'll break down what your home would likely sell for, what concessions might look like, and what you'd actually net after everything. No pressure. The biggest mistake we're seeing right now, homeowners making decisions based on last year's market. This isn't last year's market. It's more stable, more balanced, and for those who understand it, full of opportunity.